Well, greetings, test takers. I am really excited to welcome to you the first leg of your testing journey. Well, for most of you, the first leg of your testing journey, your SIE exam. This will be our third practice test for you on the channel in the SIE playlist. We have the FINRA practice test that I've explicated. So other people have done that. I've gone through, explained the questions, the right answers, the wrong answers. I think what makes my explication of that a little different is not only do I talk about the right answers, I talk about the wrong answers. So that's the first one that's available for you. It's been very popular and it's timestamped. So you can actually go to the timestamp if there's a particular thing you want more discussion on. And then the second practice test that's available to you is a little riff that I did based on that practice exam. So I kind of rotated around a little bit, and that's practice test 2. And this is going to be the third practice test that's available to you on the SIE playlist. And this comes from a collaboration that we have with TestGeek Exam Prep LLC and its managing member, Brian Lee. As part of that collaboration, what you're going to get to see tonight is what is usually a paid supplement. My channel is a free supplement to your paid study materials. Not trying to be a substitute for that. TestGeek Exam Prep LLC is a paid supplement to your paid materials. And we get 20% for our viewers and subscribers on TestGeek Exam Prep LLC. Their video course on the SIE is $99.95. There's 12 videos there. I'll link to the TestGeek website, and I'll link to a Brian Lee, managing member YouTube video from the SIE introduction that you can check that out. And if you like it and you want to get that as part of your additional resource, it's there for you. I would tell you, Brian also offers a bundle package. So if your second leg is going to be a 663 or a 766, check out the bundle pricing as well. Okay, so let's get started on explicating this practice test. All right. I'll comment along the way. So sometimes what's explication mean? It just means going through and talking about questions and right answers and why they're right and what the wrong answers, why they're wrong, and when they would have been the right answer. So it's basically just a conversation around practice questions. What that is, it's just a fancy word for that. So which of the following securities is marginable? The purchase of a listed stock in a custodial account, you're definitely going to get tested on UTMA accounts. Uniform Transfer to Minors Act accounts on your SIE, or Uniform Gift to Minors Act. And you definitely need to know you cannot use margin in a custodial account. You also need to know that the kid's tax ID number goes on the account, and you need to know one minor, one custodian per account. So no margin is going to be available in a custodial account. We don't lend money to buy new issues. Very testable. It's considered a new issue 30 days from the effective date. So a broker dealer can't accept new issues as collateral and can't extend credit to buy a new issue. And here, open-end funds are continually offering new shares to the public. And here, Brian says 15 days. So no can do. We don't lend you money to buy options. Now, so that means the answer here is going to be C. Now, I wouldn't get too hung up on margin unless you're coming back, for your 7. Then it's going to be a little bigger deal. But not even then, it's not too big a deal. So this one, the big takeaway from this question is not so much that it's C, it's that on your SIE exam that we don't allow the use of margin in custodial accounts. We don't allow margin for purchase of new issues, considered new issue 30 days from the effective date when it goes public. Every share in an open-end fund is a new share, and we don't lend you money to buy options. All right, the city of Philadelphia issued $100 million in municipal debt 3 years ago. The bonds were issued with a 20-year maturity and carry a 5% coupon. It's backed by the city's taxes and the full faith and credit of the city. Very testable to be able to distinguish on your exam between GOs and revenue bonds. That's a GO bond, a general obligation bond. And then definitely know who would a municipal bond appeal to, somebody in a very high tax bracket. So revenue bonds are backed by user fees. This is very testable. We have, the difference between open-end and closed-end funds. Listen, if you're coming back for your Series 6 top-off, or you're coming back for your 7 top-off, Mutual funds are big on the SIE exam, and they're big on 7 and 6. I have a lecture on mutual funds. I highly recommend it. No surprise. That lecture will put you in good shape for your SIE, as well as put in good shape for whatever comes next. And on all the exams, it's testable to know the distinction between an open-end fund that's continually offering new shares to the public and a closed-end fund that trades supply and demand. So the answer number 3 is B. Any sale of securities outside associated persons or the employing members' firm's regular business is D. I would also know what's that called, so I would know that as a test term. Let me get my annotation tool out here. That is known as selling away. So on your exam, they might say an associated person of a broker dealer. That's somebody who's taken a 6 or a 7. An associated person of a broker dealer sells an investment not sponsored by the employing firm without permission. This is a prohibited practice. It is known as selling away. Selling away. Which of the following terms best describes a debt instrument secured by the pledge of the issuer's property? So corporations capitalize themselves with equity and debt. Equity always precedes debt. So the corporation will first issue common stock. And then perhaps, they just have common stock, but they might decide the corporation to issue preferred stock. And then debt, they might decide to issue some bonds. And in the bond category, if they decide to capitalize a business with some debt, they're going to have secured bonds and unsecured bonds. And so bonds that have pledged securities as collateral, those are being collateralized bonds. Now, the other thing you need to know is where these go in order of liquidation. And the secured bonds come first. So this is called a collateral trust certificate, and that's secured by marketable securities placed in escrow. What you might want to do when you're doing this explication is, maybe too late, maybe roll it back, but you might want to pause it, see what your answer was, and then compare it to, whether you got it right or wrong. And the other thing you might want to do is have a stack of 3x5 or 4x6 cards. And so, you can, make a flashcard, particularly if I tell you it's something you should be aware of. Now, equipment trust certificates are also collateralized, but those are collateralized by major movable equipment. Airlines issue lots of equipment trust certificates. So if this would have said, which of the following best describes a corporate debt instrument secured by major movable equipment, then the answer would have been D, an equipment trust certificate. If they would have said, which of the following terms, if Brian would have said, which of the following terms best describes a corporate debt instrument secured by the full faith and credit of the corporation, that would have been C. And so the answer here is B. Now, I think Brian's done a pretty good on the distractors. That's the technical name for a wrong answer, because all the wrong answers could have been right to a different answer, to a different question. Unit investment trusts are assets are professionally selected and passively managed. I think that's very low probability on your exam. 6, for investor, what represents total return? Mr. Buffett was being interviewed about his investment in Bank of America. Berkshire Hathaway owns 1 billion shares of Bank of America. Bank of America pays an 84-cent dividend. So that means Berkshire Hathaway, 84 cents times 1 billion shares, is going to be receiving $850 million in dividends from Bank of America. And when they were interviewing Mr. Buffett about why he likes Bank of America, he said, well, I think I can get a good return from the income stream of the dividends. And I think if Bank of America builds the business, I think the stock could go up as well. What I'm interested in is total return. And he says, I think it's a good value proposition in terms of investing. He loves total return. That's D. Right. So if you buy the supplement from Brian, one thing I might suggest, and if you've been with me a while, I'm hoping you'll stick with us for the rest of your journey. We have Series 6 playlist, Series 7. Series 7 is the only playlist on the channel where I have 5 separate playlists for Series 7. I have exams, I have practice exams, I have content outline explication. What else do I have? Practice exams. And I have some tutoring replays as well. But anyways, if you join us for the rest of the journey, you'll hear that I like to take questions like this and turn them into what I call a poor man's flashcard. And what I mean by that, or a lazy man's flashcard, what I like to do is get rid of the wrong answers. And assuming you have the PDF, don't ask me for the PDF. I'm not sending you to the channel as a free supplement. So I'm not sending you anything that I have on the channel. Brian is a paid supplement, and if you buy his paid supplement, you would get this as a PDF. And if you have it as a PDF, I'd make it a poor man's flashcard that way. If not, you're just gonna have to make your own flashcards based on stopping the screen and making a flashcard. The penny stock cold calling rule. Now, a lot of your SIE is definitional. A lot of your SIE exam is definitional. Hence, recognition. Lots of recognition. The 3 styles of questions are recognition, practical application, and judgment. There's very few judgment questions on the SIE. And not a whole lot of practical application, but lots of recognition. And so I don't have to give you the disclosure document if you're an established customer. Now, what makes you an established customer is if you've done 3 trades or had funds with us for a year. Now, the other thing I would know on the SIE is the definition of a penny stock. It is a non-NASDAQ OTC stock under 5. A non-NASDAQ OTC stock under 5. And another thing I could know on my SIE is that if there's a penny stock in your brokerage account, you're going to get a monthly account statement. Usually we send statements quarterly, but if there's a penny stock in your account, you're going to get that monthly. So again, I hope you're taking notes. I hope you stop, rewind, go back and make sure you're paying attention to what Dean is telling you you're held accountable for on your SIE exam. So, when you own common stock, you have certain rights and privileges. Certain rights and privileges as stockholder, because you're an owner of the corporation. And as an owner of the corporation, you have a right to examine the minutes of the meetings by the board of directors. You have a right to receive audited financial statements annually. The financial statements annually are going to be a balance sheet, an income statement, and a statement of cash flow. Now, you're going to get those financial statements in 3 quarterly reports, and then the last report is the annual report, and that's the one that's audited. So the corporation doesn't have to give you on the quarterly reports Q1, Q2, Q3, first quarter, second quarter, third quarter. That doesn't need to be audited. But the 10K, that's the annual report that will be audited. And you have a right to vote on matters pertaining to the corporation. You don't, that's the whole point of being a stockholder. You don't participate directly in the management and wouldn't want to, by the way. So A is the correct answer here. All those other things are rights. Now, again, if you are going to take my suggestion on the accepts, if I was going to turn this into a poor man's flashcard, I would get rid of the accept. Whoops, sorry, I got the wrong thing going. Here we go. Boom. I would get rid of the accept and get rid of the A choice. And now what I would have is the things that are truthful that I'm supposed to know. And, maybe I annotate this and maybe I put a 1 here and I put a 2 and I put a 3. And those are the 3 things I should know about being a common stockholder. By the way, you don't have to attend the shareholder meeting to vote. You can vote by proxy. Nine, a registered representative is introducing options terminology to a client, nomenclature. Now, I have the options lecture in the SIE playlist. I have a whole bunch of options for you if you come back for 7. But I have 3 lectures in there for your SIE. I have an introduction to options, terminology, nomenclature, that's a fancy word for terminology, vocabulary. I have one on basic options, and I have one on stock plus options. Now, if you're going from SIE to Series 6, I'm not so sure how much work you want to do on the options, maybe 3-4 questions on the SIE. If you're coming back for the Series 7 top off, 20 plus option questions, it becomes a bigger deal. So again, as I said, most of the questions are going to be on your SIE recognition. All right, of the following, which would be an accurate explanation regarding owners and writers of listed equity call options. So, the option contract always has two parties, somebody who is the owner of the contract, long the contract, and has a choice, and somebody who's written the contract, short the contract, and has an obligation as a potential victim. Now, it's important here that it's a call contract, because we have two types of contracts, call contracts and put contracts. So the owner of a call has a right to exercise the contract, and the writer would have the right to buy. No. Writers don't have choices or rights, REGHT. They are potential victims. That is not correct. The owner of the call is obligated. No. If you own an option contract, you're in control. If you want to be in control, you need to own the option. That's not true. You don't go, nope. There we go. You have a right to call the stock away. You have a right to call the stock away. So the owner of the call has a right to exercise the contract, and the person who is the writer has an obligation to sell at the strike price. If they didn't want to do that, they shouldn't have, written the option contract. A breakpoint sale. Now be careful on the test, RTFQ. Read the full question. I would actually amend that to say not only read the full question, but read the full answer set. Now, a breakpoint is a good thing. A breakpoint is a quantity discount. A quantity discount. It's like Costco, right? I go, man, I don't need 2 tons of salt, but it's so cheap. I had this today. I had a person who said, Dean, if I buy $1,000 worth of tutoring, will you give me a deal? I said, what you're asking me for is a breakpoint, a quantity discount. Certainly, I'd be willing to give you a quantity discount like a mutual fund. And then a breakpoint sale, very testable, is a violation of the code of conduct. And that's why I'm trying to maximize my commission by avoiding the breakpoint. Now, the easy way to stay out of trouble is to tell you all the ways to get to reduce sales charge. So this is definitely a violation of the code of conduct. So let's see. The sale of an investment company shares in dollars amounts just below the point at which the sales charge is reduced. That's it. I haven't been a retail broker in decades, and I retired as an institutional broker. But when I was a retail broker and started my career as a baby broker, I sold a lot of mutual funds. And I sold a lot of the Franklin tax-free funds. And Franklin had a quantity discount if you invested $100,000 or more. I don't know what it is today, but in those days, decades ago, it was went down from 4% to 3% as the load on the A share if you invested $100,000 or more. So you say, Dean, how much should I invest? I say, you want to invest $99,999. So I'll have a 4% sales charge instead of a 3% sales charge. Absolutely not. Now, the easiest way to stay out of trouble is to tell somebody how they get the reduced sales charge. I wish other businesses were like ours. Sometimes I have to ask, is there some kind of deal I don't know about? Right? I was staying at this hotel, everybody checking out had different prices. And they said, are you here in business or leisure? I said, well, you tell me the rate and I'll tell you why I'm here. I said, well, Dean, if it's business, it's $300 a night, leisure is $150. Well, leisure it is. So we tell you always get the rate breakpoint. So I say, hey, you can get this with a letter of intent that can be backdated 90 days. That's the easiest way to stay out of trouble. A municipal financial professional wants to make political contributions to a candidate for the mayor that she resides in. This is called pay to play. We don't want politicians being, bribed, so to speak, to do business with a particular firm. And so the most I can give to a municipal financial professional, somebody who's involved in the muni business, very much a name and shoot point and click recognition question, is $250. And I have to be able to vote for them. D, $100 is the gift or gratuity of an associated person of a member firm A to member firm B. So 100 is the right answer to a different question. A registered rep working for a broker dealer takes a position on the board of directors for compensation. By the way, any outside business activity, key point, compensation. That means this is an outside business activity. And outside business activities require prior written notice to your member firm. Member firm means member of FINRA. I came in the business, we're 8,000 FINRA member firms. I think last I checked, we're down to like 3,700 FINRA member firms. So you don't need your sponsorship for your SIE, but if you are going on to your 6 or your 7, you're going to need sponsorship from a FINRA member firm. And when you pass all your exams, you would be an associated person of a FINRA member firm. The answer is A. The answer is A. And again, I think that's a good poor man's flashcard. You know, one of the rights I have is a right to maintain my proportion ownership in a corporation. So, you know, if the corporation has 2 million shares outstanding and Dean owns 200,000 of those shares, I'm a 10% owner. You know, if that company goes to issue additional equity financing, issue more stock, they have to first come to me and all the other shareholders and say, would you like to maintain your proportionate ownership? What it amounts to is that I, as the existing owner of a corporation, have the first right of refusal on the issuance of new shares. I have a right to maintain my proportionate ownership. Now, the way we're going to do that is through what's called a rights offering. And you have to be able on your SIE exam to contrast rights. Let me get out I'm going a little overboard on this explication because I just want to err on giving you too much rather than not enough. And, you know, you always have a pause button. I've set my little timer for 30 minutes to let you know when it's a 30-minute break. So I have no expectation you're going to sit down and watch this for, I don't know if it comes in an hour and a half, whatever it comes in at. But you do need to be able to contrast rights versus warrants on your SIE. And so the way we're going to do this is the corporation is going to go to the existing owners like myself in this example and say, Dean, would you like to exercise your rights? Would you like to maintain your proportionate ownership? And what you need to know about rights on your SIE is that rights are short-term and at issuance exercisable below the current market price. That's to give me an incentive, by the way, to come up with the money. I still need to, you know, if I exercise, come up with the money, but you know, that's, you know, say, hey, Dean, if we get it from the existing owners like yourself, we won't have to hire an investment banker and we're going to pass that savings on to you. So at issuance, they're exercisable below the current market price. And then warrants are long-term and exercisable above the current market price at issuance. And so very testable, be able to contrast rights with warrants. We usually use warrants. Corporations' warrants are usually used as a sweetener to get people to do things they might not otherwise do. And so that's when we use those. Okay, so let's see. Common stock or preemptive right. Yeah, the vote for the board members, yeah, but that's not the preemptive right. It's a right to maintain proportionate ownership. You have a right to your proportionate share of dividends. That's pro rata share of dividends. That's not what the question's about. I'm just looking at the other answer sets. RTFQ. I'm just seeing if there's any answer I like better. Any agrees? Nope. Market risk for shareholders can best be described as, you know, that the shares are going to go down. You know, you are last in line in liquidation, but that's not market risk. Market risk is risk associated with the market. That's also known, by the way, the fancy word for that is systematic risk or systemic risk, the risks in the market. As I'm coming to you, test takers, from where we've just experienced a 10% correction. Correct definition of correction is a 10% downward move. And so I don't care what stock you have, it's probably down. There's a tendency of securities prices to move together. And so the answer here is B. The other version of this is non-systematic risk, selection risk, and those are risks unique to the corporation. All right, 15. An intrastate offering of a direct participation program. So intrastate is one of the safe harbors. That's language I would know on the test, safe harbors. If you ever talk to an attorney about any legal issue and you say, are there any safe harbors I should be aware of, you know, that I can use? You know, my brother is involved in cannabis and hemp here in Nevada, where I'm coming to you from fabulous Las Vegas. That's where my studio is located. And, you know, my brother says to an attorney, what's the safe harbors for a guy like me? You know, I need to make sure he stays within the regulatory framework. And a big part of a regulatory framework is what we call the Securities Act of 33, known as the Prospectus Act or the Paper Act. You know, sometimes you can get questions right by covering up the screen. Are they asking about paper or people? You know, Congress, when they passed 33 in December, knew they were going to come back in January and pass 34. Those were companion pieces of legislation. And at the time, that was President Roosevelt, and all that was called the New Deal. And so as part of the New Deal, you know, prior to 33, I'd say, trust me, you'll love it. 33 says you're going to sell brand new securities to the public, you're going to have to make a registration statement, unless you would have a safe harbor or what we call an exempt transaction. So safe harbors are exempt transactions. 33, meaning you're not going to have a registration statement, and you're not going to have to, file with the SEC. And the one that Brian has here is what's called Rule 147. Rule 147, an intrastate offering of securities. So an interstate offering of securities, that's going to be one of our exempt transactions from 33. And so the answer here is going to be D. Now, I wouldn't worry so much that it's an offering circular as knowing that it's a safe harbor under 33. And then Reg D, you definitely should know that. Reg D, that's not this particular question. This question is that, but Reg D are private placements. And as another safe harbor, I tell the SEC, I did not sell this offering to the public. I sold it as a private placement. I only sold it to accredited investors. And Veritas will know what is an accredited investor, right? $1 million net worth, exclusive primary residence, $200,000 the last 2 years with the expectation of $200,000 this year. Married to filing it jointly, $300,000 for the last 2 years, expectation of $300,000 this year. And if that's what I have, if I'm accredited, then I can accept an invitation to invest in a private placement. So again, I don't think the big takeaway isn't that it's a circular. The big takeaway is that an intrastate offering of securities, a Rule 147, is a safe harbor under 33, meaning you don't have to make a registration statement, the issuer, with the SEC. For the owner to be paid a dividend, the name would have to be included on the shareholder list. It takes a couple days to show up on the shareholder list, right? So I'll just give you an example. The issuer says, we're going to look at our shareholder list. We're going to look at our shareholder list on Thursday, September 16th. I'm just making that up. And if you're on our shareholder list on Thursday, September 16th, you're going to get the dividend. That's called the record date. That's when the company looks at their shareholder list and says, if you're on our shareholder list on that date, you get the dividend. So as you see here, for the owner to be paid the dividend, they have to be included on shareholder no later than the record date. Now be careful what you're being asked. I like Brian here. Brian's being kind of a little bit of a jerk here. He didn't ask when's the last date you can buy the stock. The question wasn't the last date you can buy the stock and get the dividend. He's just saying when you got to be on the list. So the answer is B. Now, if Brian in this question would say the first date on which the stock no longer trades with the dividend attached, then that answer would have been A, the X date. And the X date is 1 business day prior to record. So that's not what they asked in this question. And he just said, well, you have to be on the list. But Wednesday here, I'm going to get a different color. Wednesday, September 15th is what we call the X date. The X date is the first date on which the stock no longer trades with the dividend attached. The price received for purchases and redemptions of shares of the open-end investment company is determined by B, the next calculated share price. Very testable, and that's called forward pricing. In an open-end mutual fund, we're always doing business based on the next calculation of the NAV. It's called forward pricing. And then the Investment Company Act of 1940 says that a mutual fund has to do that at least once per business day. An issuer of a new municipal bond would file which to disclose, looks like a little grammar problem here. I kind of pushed Brian to, he wanted to clean this up a little bit, because I know his mentality, it's a good thing. I said, listen, Brian, don't let the perfect be the enemy of the good. We got people who are testing, and I want to be able to share your paid content with them in this free look that we're doing tonight. And so, please don't say anything like if I find a little typo here, because he'll be upset that I kind of pushed him. I said, listen, we got to keep this train on schedule for our test takers. Anyways, 18. An issuer of an municipal bond would file which to disclose to the MSRB. Well, I do like this again, because what Brian's getting at here is municipal bonds are exempt issuers of securities. They're exempt from 33. By the way, I just hit my little button here, my little egg timer telling me we're at 30 minutes. So let me just finish this up here. I would know that the US government is exempt issuer, meaning they don't have to comply with 33, and municipalities are exempt issuers. And so when selling municipal bonds, we don't have prospectuses because I just told you they don't have to comply with 33, they're exempt issuers. And so what we have is an official statement that serves the same purpose. It's to help people make an informed decision. And so the answer there is C. I would definitely know that official statements are used in selling brand new municipal bonds. I would know the issuers of municipal bonds are going to be states and municipalities. There are 50,000 issuers of municipal securities. 50 of them are states, so 49,950 cities, counties, transit districts, school districts, so on and so forth. Okay, so as I said, at 30 minutes, if you want to kind of take breaks on this thing, 30 minutes is the time to do so. I'm going to continue to march on, and I've reset the timer for another 30 minutes. And, you want to try and kind of push your sustained concentration ability based on taking a test. So, 30 minutes, I think, is good, but try and work up to your test that, you can do 75 questions without getting too tired. Because I do think some people just miss the mark because they get tired. All right, so let's see. We're onward and upward for us. Welcome back. If you took a break, welcome back. In a secondary distribution, so secondary means the previous owner is receiving the money. Distribution means we're going to go through that whole process of 33. So even though this is not going to be new shares, it's not going to be a primary offering, we're going to comply with 33. And the point here is the shares in a secondary distribution, 19, the shares are from the existing shareholders. Fidelity is privately held. Fidelity, 40% of Fidelity is owned by the Johnson family. 60% of Fidelity is owned by the Fidelity employees. And if Fidelity went public, maybe it would be a secondary distribution, meaning maybe you're not buying new shares of Fidelity, but rather what we're selling to the public are the shares that were once owned by the Johnson family. And, they're cashing out or, diversifying, whatever the case we want to say. I'm coming to you from Las Vegas, Nevada, but we have a corporation in California called In-N-Out Burger. In-N-Out Burger is privately held. It's controlled by the Snyder family. So we need to know if they go public, is that money being raised to build more In-N-Out Burgers, or is that cashing out the, the existing owners? I like that as a recognition question. Shares are issued from the corporation existing. A would be a combination offering. And if all the shares are issued from the corporation, that would be a primary offering. And so C is the right answer here. When a limited partnership, so you're taking a test on the securities industry essentials, and so securities are a part of that. I would expect not a lot, and maybe one question on partnerships, maybe two, but limited partners provide the money, and partnerships, unlike corporation, have a finite life. So we're going to go out and, one of my favorites that I use, and probably, if you're going to join me for the SIE, and then your Series 7 or your 6, and then your top off, you'll probably get tired of hearing Dean stories. You're probably going to send me a nasty thing, say, Dean, get some new stories. But anyways, I did a partnership where we raised 8 to 12 million to buy all cash real estate and build Del Tacos, called Del Tacos for restaurant properties. And then at the end of 10 years, what we do is we sell off the real estate. And so partnerships have a finite life. And when we sell off the assets, we pay off the secured creditors, the limited partners, the general partner gets paid last. D. I think the main test question that I would be ready for on my SIE exam is partnerships are not liquid. You can't get in or out of a partnership without the permission of the general partner. So they're totally inappropriate for somebody who needs their investments to be liquid. Market interest rates have been rising. What would be on the effect of market prices, existing bonds in the secondary market? So ladies and gentlemen, if anybody ever asks you about economics, finance, or investments, and you want to sound smart, you should say it has a lot to do with interest rates. And if you just shut up, you sound good. People say, well, what about them? You say they fluctuate. They say, is that good news or bad news? You say, well, it depends. Can you tell me more? We're going to torment you. We assume everybody in the securities industry knows there's an inverse relationship between interest rates and bond prices. So when interest rates go up, bond prices go down. I would definitely know that inverse relationship. 22. A client and his sister, both of whom are married, would like to purchase shares in the XYG mutual fund. They both will contribute 50% and would like their portion of their assets to go to their families. So they want the decedent share, the decedent's the dead person, to go to their families. As the registered rep, what type of account would this be? I like this one a lot. You should definitely be able to contrast on your exam joint tenants with rights or survivorship with this one, tenants in common. You know, tenants in common, the decedent share goes to their estate or the beneficiary, or in this case, their families. Where with joint tenants with rights or survivorship, the decedent share goes to the surviving party. So make sure on your exam you can contrast joint tenants in common, the answer here, with joint tenants with rights or survivorship. A corporate bond has a coupon of 6 1/4. At the present time, its yield to maturity is 6 3/4. So if the corporation has agreed they're going to pay you 6 1/4% based on par, that's also known as the nominal yield or the fixed or stated rate of return, and you're going to make 6 3/4, that means you must have been able to purchase that bond at a discount. Now, I highly recommend, whether it's, I have a lecture called Forward Bonds, Not James Bond, Forward Bond, Not James Bond, in the playlist. And, we're going to show you how to use a teeter-totter or a seesaw to figure this out. And we're going to show you this. Again, this isn't a lecture. This is a explication. All right. So that's 6 1/4. And now they're telling me that if I buy this thing, I'm going to make 6 3/4. And so in that lecture, or whoever your supplement, your paid vendor is for this, we say, okay, well, that looks like, that looks like this, right? So the yield to maturity, and this is what we call the coupon. And again, you're welcome to watch my lecture. This is called the teeter-totter seesaw. What I'm showing you here is that when interest rates go up, the bond price goes down. And I was able to figure out that interest rates have gone up because it told me in the question that the bond now yields that 6 there. All right, 24. A company has issued a cumulative preferred stock, So what that means, if the corporation misses a payment, it goes into arrears. A preferred stock has preferential treatment in 2 areas. If I own a preferred stock, I have preferential treatment in 2 areas. The corporation can't pay a dividend to their common until they've taken care of the preferred stockholders like me. And I have preferential treatment in liquidation. If the corporation goes under, myself and the other preferred stockholders get paid before the common stockholders. We're what's called a senior security in liquidation. We're only senior to the common. So cumulative means if I miss it, it goes into, don't you like this fancy word, arrears. It's like if you miss your phone bill, right? You miss your phone bill and then next month you owe 2 payments. So forces the conversion of the preferred that's trading at discount. Therefore, no, that's just nonsensical. I mean, Brian's good at making up stuff that sounds like, what is that? That's just a wrong answer. It's a distractor. There's nothing about conversion here. Pays omitted in current preferred preferring dividend on common. Ding, 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 ding. Right? That's the whole point. They got to get current on the arrears before they can pay a dividend on common. So B, is the answer. B is the answer. All registered rep must complete training that covers practice and process of their firm. You got to do that annually. So be careful. They're not asking about your continuing ed requirement, regulatory continuing ed. They're just asking about what the firm needs to do. And the firm needs to do that annually. Your customer, an income investor, has indicated they'd like to receive quarterly income. Stocks pay quarterly if they pay at all. Some stocks don't pay dividends, but if they do, they pay quarterly. Bonds pay semi-annually. And so I should have been able to get this by process of elimination because I only have one stock there. And utility stocks are typically mature, stable, and can afford to pay out a portion of their earnings as a dividend. So I could either know that this is a stock, or I could use process of elimination on this one. A customer would like to invest $73,000 into a mutual fund with a breakpoint at 75,000. We talked about this. So this mutual fund is saying that if you'll invest 75,000 or more, we'll get you a reduced sales charge. That would be wonderful. Because if you get a reduced sales charge, you'd have more money going into the fund. You'd have more fund shares. So that would be an excellent idea. Inform the customer you reduce his sales charge by investing an additional 3,000. I don't think he needs 3, he only needs 2 to get this done. Place the order as instructed, and there we go. Boom. I say, listen, Mr. Customer, do you think that within the next 13 months, you might be able to come up with an additional $2,000? Because if so, we should sign a letter of intent. It's only binding on you. It's not binding on the mutual fund. You say, well, Dean, there's no chance I'm coming up with the money. I say, well, okay. And then you call me 30 days later and say, oh man, I should have signed it. I said, well, no problem. It can be backdated 90 days. So a letter of intent is good for 13 months and can be backdated 90 days. 28. Your customer receives a 10% stock dividend on 1,000 shares. Now I'm going to show you a trick, or just tell you a trick. And if you want to use Dean's trick, if you want to use my trick, you always know that when you have a stock dividend or stock split, you're going to end up with more shares. So now I have a 50-50 at a lower price. So I'm going to have more shares at a lower price. So if I don't want to do the math, I could just say, okay, I need more shares at a lower price, something more than 1,000 at something less than 50. And that means I have done it without having to do the math. So that's going to be choice. Whoop. That's going to be choice C. Now, if you want to do the math, what you would do is take 10% times 1,000. That's 100 additional shares. I'm getting 100 additional, so is everybody else. Then I take my original cost base, which was $50,000, and I would do that. Your customer purchases a AAA rated corporate bond above par. So the way we say that in bond speak is that you bought that bond at a premium. You bought that bond at a premium. So again, this is another one of those teeter-totters. So if you buy the bond above par, it's premium. If you buy it at par or below par is a discount. Something less than 100. And it says if you buy it at a premium. So again, what we're going to do here is draw our teeter-totter line, right? Our teeter-totter line. And there's what that looks like. You buy it at a premium. The middle line is a bond at par. And remember, we said the thing that makes this teeter-totter work is the nominal yield. Again, I'm not doing a lecture here. I'm just explicating a practice line. You could watch the bond, Ford bond, not James bond, if you want to do more of this. And this is where we're going to find the current yield. And what I like about the teeter is it turns judgment questions into aim and shoot, point and click questions. And so on question 29, I know now that it says the yield to maturity. So the yield to maturity is going to be in here. Let me get another boom. There is yield to maturity. And so now I found out that 29, the answer is B, that the yield to maturity is lower than current yield. That's called the teeter. I don't know where you're in your study effort. It's kind of aggravating to me, but you should do some study before you jump on and start doing practice files. So I'm assuming that you've laid some base knowledge before you're looking at these practice exams. So maybe that's not true, but you know, you should have done some work before you start doing practice questions. There's no shortcut to this thing. You got to lay the base and then you got to start doing practice questions. All right, 30, all the following are money market securities except Yeah, treasury bonds maturing in 5 years. Now, money market securities, I would definitely know the definition on your test. Money market securities are high quality debt maturing in less than 12 months. High quality debt maturing in less than 12 months. And the treasury bond says maturing in 5 years. We can toss that out. Negotiable certificates of deposit. Again, negotiable means there's a secondary market. I would definitely know that bankers' acceptances are used to facilitate foreign trade. I don't know why they like that on the test, but they love it. And repos are where I pledge my treasuries overnight as collateral to get a loan. All right, so you quote the price of XYZ at 72 on the bid. Now, whenever a customer is looking at two prices, the customer always receives the low price and always pays the high price. What's that called? That's called the securities industry. And that's how we make our money, the difference between what we buy things at and what we sell things at. So customer sells at the bid and the customer buys at the ask. Which statement is true? 72.25 is currently the best price your customer can sell. No. Remember, the customer doesn't sell at 72.25. The customer sells at 72. I think a good analogy to the car business, right? If you come into my Lincoln dealer, I show up and you say, Dean, how much for Lincoln Navigator? I say $90,000. And you go, great, I've got one. Where's my $90,000? I say, ooh, I'm sorry. I misunderstood you. I thought you wanted to turn money into a Navigator, and I gave you my asking price of $90,000. Now I get it. You want to trade in your Navigator 40 grand. I say, oh my God, what's that? That's the spread. 72 is the best price your customer can buy. No. The spread is 10 cents. No, the spread is the difference between the bid and the ask. And so the spread here is 25 cents. The spread here is 25 cents. 72 is currently the highest price. There you go. Any buyer is willing to pay. That's right. So 72 is currently, yeah, that's what the market maker buys at. And so the answer to 31 is D. You'll probably get a question like that. I'd also be prepared for the size of the quote. The size of the quote, they're going to ask you the size. I have one, the FINRA practice exam, I have one just like this. And I also have it in my other practice exam practice. I'm calling to keep them in the playlist so you can tell which one. This is practice test 2. Mine is practice test 1. And then there's the FINRA one, which is just the FINRA, exam. But you should expect to get a question like similar to that. A Senator Roth is no longer here to protect his Roth IRA. If you're a senator and you come up with the idea, we name it after you. And Senator Roth came up with this thing. And I think that should be an I there. It's telling me that we have a misspelling there. Anyways, I told you, I kind of rushed Brian to get this to me because I have a publishing schedule of every Tuesday. And I said, listen, don't let the perfect be the enemy of the good. Let's get this thing out there. Anyways, the point about a Roth that's so sweet is there's no required minimum distributions. And there is a means testing to it. And so the answer 32 is B. A difference, Roths aren't going to be after tax money is what Brian's getting at in that question. All the following would be acceptable gifts from a member firm to give to the employees of another broker dealer. The gift or gratuity rule is very testable. The maximum gift or gratuity an employee of one member firm can give to the employee of another member firm, test question, is $100. And it doesn't account normal deductible business activities. Please note, D is a normal deductible business activity. C is a normal deductible business activity. The $20 box of chocolates is under $100, and an all expense trade trip to Bahamas. Ooh, I think that's going to be way over $100. So given that answer set, I would have got this right using what I call the Sesame Street trick. One of these things is not like the other. If a registered rep possesses material non-public information, inside information, under what circumstances can he use that? Oh, excuse me. One would be considered illegal. Man, things get tired here. If you tell a customer, if the customer enters an unsolicited order, if the withhold information until it's made public, If he tells the customer, use the information to trade. Now, I don't like any of these, to be honest with you. This is one of my favorite Brian questions, but that's the most egregious thing. You should just keep your mouth shut. But given that answer set, that's my best answer. Sometimes, we have what we call the most appropriate answer. But when an investor wants to borrow shares to sell short, the shares would be returned to the broker dealer. So one of the risks I have, if I call my broker and say, listen, I want to borrow 1,000 shares of stock, first point, whether I want to borrow money or shares from my broker dealer, I need a margin account. All short sales must be conducted in a margin account. And so there's a locate requirement. They say, Dean, let's see if we have a customer who said it's okay to lend their securities and signed what's called the loan consent form. And they say, Dean, we were able to borrow 1,000 shares of Zoom. I'll just make it up. I say, cool, sell the Zoom short, sell the stock I don't own. Now, most businesses, that's called fraud. But in our business, that's just called selling short. Now, one of the risks I have is my broker dealer may call me and say, Dean, the person we borrowed the Zoom from wants it back. And I say, well, I'm not prepared to close out my short sale yet. And they say, well, too bad, too bad. By the way, selling short is incredibly dangerous. It subjects me to unlimited risk. And so it behooves me, if I'm going to sell short the stock, maybe you've heard that saying, don't sell that person short. They might, surprise you. That I could do something like enter a buy stop or buy a call. There's a lot of smarter things I could do. Which oil and gas would have the least amount of capital risk? Now, I don't like the way Brian phrased this, but I would know if we buy proven producing reserves, we're going to have less risk than if we go out and do exploratory, also known as wildcatting. That's the most aggressive we have. Developmental is we go next door to somebody who found some, they found some. It's likely we'll find some. Again, I don't think this is the question you're going to see about an exchange traded fund. That is true. But I would definitely know that exchange traded funds, you need to be able to contrast them with open-ended funds. What I mean by that is ETFs are traded supply and demand in the secondary market. ETFs can be purchased on margin. Open-end funds cannot. Right. So the way we sometimes say that is exchange traded funds are continually priced. REITs, real estate investment trusts are like mutual funds. You buy a REIT for the same reason you buy a mutual fund. Professional management, diversification, ease of ownership. It's not a proportion ownership or pooled investment in securities. It's proportion ownership or pooled investment in real estate. This is definitely testable in terms of vocabulary. American style is typical of equity options. And one of the risks you have as somebody who's short an American option is you can be exercised anytime. European style can only be exercised at the end. 38 is very testable. Now, by the way, you're looking for confirmation on practice test 2 that we're explicating now, Dean's practice test 1, the FINRA practice test, your paid prep provider, whether it's Kaplan or STC or Past Perfect or Knopman or Solomon. If you see the same question in everybody's materials content, that's just a hint that it's there. I don't know about you. I like to, when I'm taking a test, get to the first question I know the right answer to. Hopefully I'm not like 20 deep before that happens. I say, all right, something on here I know, something on here I know. Which investor would not classify as an accredited investor? Well, accredited investors are living, breathing human beings, walking planet Earth. This is what we call a natural person, an individual. As we said, very testable. This individual, this natural person, living, breathing, him watching planet Earth, needs to have either 1, 2, 3 is a good remember 1, 2, 3, either $1 million net worth, exclusive of their primary residence. There's the one, or 200 grand for the last 2 years in annual income with the expectation 200 grand this year, or 300 grand if they're married and filing jointly for the last 2 years with the expectation of that this year. That is very testable. And remember, they can accept an invitation, a private placement memorandum to invest. And what they're buying is unregistered securities. So A certainly meets that definition. Boom, that surely meets the definition. And then, the way we're looking at this now is we got a trust and we have an organization. I don't think this is going to be this, but this is true for Reg Ds. They can participate, but trusts don't have the definition. So I'm not a big fan of this particular test question, Brian, but make sure, the answer there is B, but make sure you know about the individuals, what I'm telling you. So make sure you know about the individual. Whoop. Whoop. Ooh. A customer with $100,000 to invest has indicated they'd like to have access to their money if the need should arise within the next year. As the registered rep, you would most likely recommend, let's see, so a blue chip stock that could sell easily, growth mutual fund, no. Given that answer set, it looks like my best answer is going to be C. Whoop. C. Which are the best describes? They like to ask you in your SIE the participants. Who are the participants in the securities industry? You know, like who's a broker dealer, who's an investment advisor, who's an issuer, you know, those job function kind of questions. And so B is the definition of a custodian. 42, which of the following, which describes the risk profile of debt securities based on bond duration? That's the fancy word for volatility. And so short-term bonds are less volatile than long-term bonds. And so long-term bonds are always going to be more volatile. Now what we have to decide here is of the long-term bonds, which one? So let's see, long-term bonds yields are fixed. No, it's going to be B. They're going to be more volatile. Now in the lecture, I tell you why. This is just an explication. Treasury notes backed by the U.S. government would be susceptible to. Well, you should definitely know that when you buy a Treasury bond, you don't have any credit risk. There's no better credit quality than that of the full faith and credit of the United States government. The United States government isn't in business, and the Treasury market is the most liquid market around. I mean, you can turn a Treasury into money very, very quickly. You know, the Treasury market, the secondary market for Treasury securities is trillions of dollars. So the risk you have is that you buy a 10-year Treasury note that pays, 6%. And when it matures in 10 years, brand new ones only pay 3%. And you can't put your money out and get that same high rate of return. Or that you're every 6 months, you're getting money that you have to reinvest it. And every 6 months, maybe you can't reinvest it at that same rate of return. I would definitely know that there is a bond that has no reinvestment risk, and that would be a zero coupon bond. Now, the Treasury version of a zero coupon bond is going to be a strip. And so we definitely know whenever you're buying a zero coupon bond, there is no income stream you're receiving to be reinvested. And so I definitely know that zero coupon bonds have no reinvestment risk. ADRs, I can't imagine any draw in which you don't get a question about an American depository receipt. You know, the main test question you should expect, high risk, high probability, is that ADRs can best be characterized as foreign securities traded in the U.S. market. You know, I always use an example, Telefonos de Mexico. If I buy the ADR for Telefonos de Mexico, what I'm buying is in the foreign branch of Bank of New York. There's, however many shares of Telefonos de Mexico, which I am the beneficial owner. That's what that receipt is for. I just gave you an example of Telefonos de Mexico, and in Telefonos de Mexico, they're collecting the phone bills in pesos, and it used to be 10 pesos to get a buck. Last time I checked, test question, the spot market is just the current exchange rate. It was 20 pesos to get a buck. And so I'm certainly going to have currency risk. Now, in terms of Mexico, we've got a new guy, the Presidente. His name is Antonio Manuel Lopez Obrador, AMLO, people call him AMLO. And he recently just nationalized a refinery that belonged to, I forget who it belonged to, some oil company. He's trying to, put the Pemex back on being in the oil business as a monopoly in Mexico. And so you certainly have political risk. Geographic risk, I probably, I could struggle a little bit with it because, Mexico, I just gave you Telefonos to Mexico, but the one they're looking for is this political risk. I would definitely know currency risk as well, very much a test question. So I know that as well. Very testable to know how ETFs are different than mutual funds. And I would definitely know that ETFs are priced based on supply and demand, or supply and demand. just like a stock. They trade just like stocks. I would know forward pricing is the open-end mutual fund. So forward pricing would have been right for a open-end fund. Your client wishes to open a 529 plan for your son's tuition. Make sure, test takers, that you can compare and contrast a 529 with a cover deal. Very high probability they're going to ask you on the test, how are they different? And what they're looking for on the test is that the 529 is the winner in that comparison. But one of the things about a 529 is there's no income limit. It's not means tested, whereas a cover deal is. As I just told you, it's testable to know how those things are different. Now, be careful. They're not asking about the gift tax. That's a different question. You know, the gift tax I think of as the estate tax in advance. And right now that's $15,000. You can front load the 529 for 5 years without running afoul of the estate tax. But make sure you contrast, make a note to yourself to review cover deals and 529s and how they're different before you take your SIE. Okay, well, that is our second 30 minutes. So I hope you're finding these explications helpful. If you are, let me know. You know, smash that like button. The other thing I'm interested in, are you watching this on I've been told that people were, 50% of YouTube are people watching on their smartphones, which is incredible to me. So that's why I'm trying to blow it up. And I'd be interested if you could tell me how you're accessing the channel through your mobile device, your smartphone, or through your desktop, just because, I'm trying to get better at realizing some people may just be listening to the audio and not watching the video. And then if you are, using a smartphone, that, I try and make my slides or whatever it is big enough that it shows up on a smartphone. All right. So take a little break if you need to. You can always stop, pause, come back. Like I say, you might want to do that just doing the questions together, see how you did. And I'm going to continue to march because I've got things to do and I want to get this up for the Tuesday upload. So I'm working on getting this thing done. Tuesday at 3 p.m. is when we typically upload new content to the channel. So that's kind of why we're kind of in a little bit of a hurry here. All right, so we left off. Welcome back. If you chose to pause and take a break, we are in question 47. We're in question 47. A registered rep would like to distribute an advertisement. Let me turn over my timer again so we can get this done in 90 minutes. A registered rep would like to distribute an advertisement to his prospective clients. Which of the following is true? Yeah, you got to have advertisements approved by your principal qualified supervisor. Now, if you're coming back for a 6, who cares? It's not testable, just for your own identification. 6 can be supervised by a 26, a 24, a 9, or 10. 7 you'll have what are called the sales supervisor, 9, 10, or 24. So who cares? It's just you have a supervisor and you better not be sending out stuff without telling somebody and getting approval. By the way, it's either going to be pre-distribution or post-distribution, depending on what it is. Make sure you understand the difference between retail communications and correspondence, because that's testable. If it's correspondence, your supervisor can do that pre or post distribution, whereas if it's retail communication, they have to have it pre-approved. An aggressive growth objective would most likely be one that invests in. Yeah, that one's pretty easy, or should be. Maybe not, but I think that's one of Brian's easier. Small companies, right? Small companies are pretty aggressive. You're either going to win big or lose big. Either it's the next big thing or it's not the next big thing. Your customer purchased a 7% callable bond that matures in 20 years. Interest rates have gone up to 9%. So this is another one of those yield relationships, price yield or yield price. And so if interest rates have gone up, the bond price has gone down. And so now the bond is trading at a discount, which the volume would be, oh, I like this one. It's easier than it looks. We just got to know that the market price is going to go down. It's going to be trading at a discount. He didn't even ask us that. Brian just asked us what happens to the market price. 144, very testable. So 144, I think a good way to remember 144 is 1% of the outstanding stock or the average of the last 4 weeks trading volume, which is ever is greater every 90 days. If you're an insider or an affiliate, we're not letting you going to disturb the public marketplace. And so as an insider or an affiliate, that's the family members of an insider, you're only going to be allowed to sell up to 1% of the outstanding stock or the average of the last 4 weeks trading volume, whichever is greater. And the form, you're going to file what's called Form 144, and that form has to be filed at or prior at or prior, and it's good for 90 days. So I could do this by process of elimination. Let's do it by process of elimination. So I can't know it's not 4%, so we can get rid of that. But 6 months after the offering. So the other thing about 144 here, and I just now I'm chopping my answer set because I was using process of elimination. There's typically a 6-month lockup for the insiders and affiliates of a company that just did its IPO. Up to 1% of the outstanding shares within 6 months, 90 days after the offering. No, it's not. The 6-month hold is on the unregistered stock. You know, it could be registered or unregistered, but you know, the 6 months is the hold. I'm not a big fan of this question, but the answer here is A, and I would have a general understanding of 144. So I think that the way I laid it out for you is going to be more testable. The answer there is A. So if I am an insider and affiliate, officer, director, principal stockholder, or immediate family member, I can sell up to 1% of the outstanding stock or the average of the last 4 weeks trading volume, whichever is greater, within a 90-day period. And I'm going to file Form 144. So the form I file at or prior, and that's what I can sell. Here recently, Elon just sold, what, $12-13 billion worth of Tesla. So Elon has to file the form, and he can sell up to 1% of the outstanding stock of Tesla, or the average of the last 4 weeks trading volume of Tesla, whichever is greater, in the 90-day period. A portfolio identified as growth portfolio would most likely invest in. No, high dividend pay ratios aren't associated with growth. Low PE ratio, value. Earnings increasing, that looks like our best answer given this answer set. Economics. I have a great economics lecture. It's called Money is a Giant Floating Crap Game. That's a famous quote from Lord John Maynard Keynes. My economics lecture is spot on. It's in the playlist. I also, I think, do it again when I explicate the content outline of the SIE, and you are going to get a couple economic questions. So increased business activity. So raising interest rates, no, that tends to dampen or, you know, contract the economy. Selling government securities. Well, when the Federal Reserve Board, test question, the Federal Reserve Board is in charge of monetary policy. And when the Federal Reserve Board sells government securities, the securities go out, the money supply comes in. It contracts the money supply, interest rates go up, and no, that's tightening money. The Fed, I'm dating myself, but the Fed has gone from, at the start of the financial crisis, having a balance sheet of $800 billion to now like $4 trillion. And what they've been doing for the last decade is buying government securities. And when they buy government securities, that means the securities go out, the money goes out, the securities come in, the money supply goes up, interest rates fall, and that stimulates business activity. I would definitely know monetary policy. That's what this question is about. The answer is C, is the Federal Reserve Board. And I know fiscal policy is government spending and taxation. So that's why this is wrong, right? But that's wrong because that's fiscal policy. And that's controlled by Congress and the president. All right, an equity REIT is, equity means not mortgages. That's the whole point of saying it's an equity REIT. So the equity REIT doesn't own mortgages. It takes out mortgages to buy property. 54, an unlisted security trades over the counter. Now, I would know the third market is listed securities traded over the counter. Listed securities traded over the counter. It's a third market trade. So Twitter is a New York Stock Exchange stock. So any trade in Twitter that doesn't take place on New York is a third market trade. Fourth market is direct trading between institutions. Direct trading between institutions. Arbitration, the composition of the panel. So customers get to decide this, but it's going to be both members of the public and members of industry. And if the customer chooses, they can just choose to have public only if they choose to. But if the question says here may consist. So 55 is the better answer. Treasury bills. I would definitely know that all money market securities, with the exception of a negotiable jumbo CD, are issued at a discount. So bankers' acceptances are issued at a discount. Commercial paper is issued at a discount. and Treasury bills are issued at a discount. Makes sense because it would be operationally almost impossible to pay people the interest. So we say, listen, it's, it's so short term, you just issue it to you at a discount, hold it to maturity. 50 XYZ offers a tender offer for stock at $10 a share for a minimum of 1,000 shares, a maximum of 100,000 shares. Berkshire Hathaway, Mr. Buffett, instead of buying his stock back in the open market, secondary market, has made a tender offer to his shareholders. So a tender offer is just an offer, and I call you as your broker. I say XYZ has a tender offer. They're offering to buy back their stock into the Treasury. This is called Treasury stock. And I would definitely know that, stock that the company buys back is called Treasury stock. So what they're doing is retiring stock into the Treasury. And I would know that Treasury stock pays no dividends. No dividends and has no voting rights. And we would associate a company that's buying back its stock into the Treasury as being a mature, stable business, generating more business, more money than it needs. And so if your customer owns 500 shares, how much would they receive? And I think Brian's kind of being a jerk here, because remember, the minimum to accept this deal, the minimum was to tender 1,000. So if the customer only has 500, he's not going to be able to participate in the offer. Once they make that tender offer, they have to leave it open for a minimum of 20 days. The city of Birmingham has issued 100 million in 4% industrial development bonds for the purpose of attracting megatech. I like this. So, what Brian's getting at here is an industrial development revenue bond is backed by the corporation, the full faith and credit of megatech. Right. So in these industrial development revenue bonds, corporate credit backs the bonds. Corporate credit backs the bonds. Again, I think that's a very good question. Your customer owns Datacomp and is interested in starting a retirement plan for its employees. They currently employ almost 100 employees. The most appropriate plan, it sounds like the most appropriate plan for an employer with less than 100 is going to be a simple plan. I wouldn't, worry too much about a couple of retirement plans. Fly high on retirement plans. No 59.5, no 72, no 10%. Know the difference between qualified and unqualified. Fly high, fly high. A non-equity option strike price is currently equal to the market price. So that means that it's at the money when that's the relationship. And the money is synonymous with intrinsic value. And so that is at the money. Here, Brian's not going to ask you to do current yield. On the test, they would ask you to actually do this. So of the math you should be able to perform on the SIE, make sure you can perform current yield. What an investment pays me divided by what it costs me. What it pays me divided by what it costs me. The VIX is an index that helps determine fair pricing of options based on the volatility of the underlying stock. Sometimes we call this the fear index. When people are fearful, they're willing to pay more for the puts than the calls. And we track that. And this is based on the S&P 500. I told you, you're going to get at least one question on 529. Primarily, it's how is a 529 different from a Coverdale? Make sure you can do that on your exam. Make sure you can do that on your exam. So the answer is plan when you can change it anytime. So it's flexible. I told you it's kind of cool. So make sure you intellectually own a 529 for your SIE exam. A customer spouse calls to place a trade in her husband's account while he's away on business. For discretionary trades, the registered rep must have, we have to have the appropriate documentation. So place trade in her husband's account. I don't see anything that she's properly approved to do this. So, sometimes customers get mad. I said, well, listen, I can't accept trades from somebody who's not on the account. Prompt notification or U4. So after you get sponsorship, so if you don't have a sponsorship, lots of people are hiring right now. So if you're taking your SIE and you're doing this to show somebody that you're motivated and you already got your SIE, kudos to you. And I would tell you there are lots of people that are hiring. And one of the things they're going to ask you to fill out is what's called a U4. That's how you become an associated person. Not testable, but if you can check every box on a U4 no, we call that a clean U4. And if you have a yes answer in the business, we call that not testable, a dirty U4. No, some answers are dirtier than others, right? Most yes answers just require some kind of an explanation. And so here is the one that requires explanation. We don't need to know about your divorce or address change, but bankruptcy. I wish the guy would have checked with me, but he had a bankruptcy. It's a yes answer. It's not reason for disqualification by statute. That would be conviction of a felony within the last 10 years, a misdemeanor involving embezzlement of money or securities, or you've been denied, suspended, or revoked registration in the past. So this isn't one of those. This requires an explanation. And then he got the state administrator of Kentucky. I joke, the SEC is God and state administrators think they are. So there's 50 demigods around. Joking. But the state administrator of Nevada protects residents of Nevada from, brokers. I'm joking, but it's kind of it. Anyways, they asked for an explanation. They weren't pleased with his explanation, and they wouldn't allow him to get registered in Kentucky, which is a problem because he answers phones where he's got to answer from any state. By the way, I think if he would have checked with somebody, they would have told him how to, make that answer so that it would sway them that, when you're answering a regulator's request for information, well, you want to go over the top and, in terms of erring on giving them too much information rather than not enough. Anyway, 66, a registrar may share in commissions with properly registered personnel, right? So if you're going to split commissions, it's got to be with somebody in your office who's properly registered. Oh, if they're not properly registered, then you can't do that. We don't give concessions, discounts, allowances to people who are not properly registered. Loans from customers be permissible if it's a bona fide loan from a financial institution. So loans would be permissible. A long-term customer, your broker dealer. No. A long-term customer, your broker dealer. Nope. A short-term customer. A long-term fund that has sense. So that's a pre-existing business relationship. I don't really care for this answer, but given the answer set, that's our best answer. To protect a bond portfolio from changes in interest rates, a manager might. So if you're trying to protect a customer, you could buy on some variable rate bonds where the interest rate moves against some base rate. So the interest rates go up, the payment goes up. So 68, the answer is A. Well, we have authorized stocks. Authorized stocks is the maximum number of shares a corporation can issue. Outstanding stock are shares that have been issued to investors, been placed with investors. We talked about earlier Treasury stock, that stock that has been reacquired or purchased by the corporation. And then we have outstanding stock, which is issued less Treasury. So, we're starting a corporation, we might authorize 4 million shares and choose to issue 2 million. And so that means we have 2 million shares that are authorized, but unissued. And if we don't want to, we don't have to sell those new shares. In fact, we might not want to, because remember, we sell the new shares, our existing owners might get diluted. And so we'd first have to come to them and give them the first right of refusal. So the answer there is D. Which position would cover a long 50 call? So covered means you're agreeing to do something. This is kind of interesting. This is an interesting question. I kind of like what Brian's getting at here, but he's kind of got it, I think, purposely phrased ass backwards. What I mean by that is if you are short the stock and you're a smart bear, you would establish the choice to buy back the borrowed stock at a set price at some future date. And so the answer here is A. Now, by the way, you could have got that with what I call the Sesame Street trick. One of these things is not like the other. Now, as I mentioned to you earlier, if you're going on to a 6 top off, maybe options aren't such a big deal. As you can see here in this practice test, we had 3 or 4. If you're going to 7, may as well suck it up and try and learn as much as you can for options. I have, I don't know, I haven't counted up. There's like 18 hours of option lectures. I know there's a lot. So we can certainly help you on the channel with that. 71, XYZ declares a 45-cent cash dividend to shareholders as of record Monday, June 9th. Now, remember what that means. That means they're going to look at their shareholder list on Monday, June 9th. And if you're there, you're going to get this dividend. So let me get out my annotation tool. Now, you should know in our business that it takes 2 business days to show up on a shareholder list. 2 business days. So, ladies and gentlemen, Saturday and Sunday are not business days. Saturday and Sunday are not business days. And so that would be the 8th, the 7th, Friday, the 6th. And let's see, we could have bought it on Friday, June 6th. Settlement is 2 business days after the trade date. So if I buy that Friday, that's the trade date. That's when we've agreed to terms. Monday, T+1, I'm not on the shareholder list. As we said, it takes 2 business days to show up on the shareholder list. So if I buy that on Thursday, T+1, T+2, kind of interesting. Kind of interesting. If I buy that stock Thursday, I would be on the shareholder list and I would get that dividend. If I bought on Friday, T+1, I'm not. So Friday is the first date on which the stock no longer trades with the dividend attached. Now there are other dates. That's the first. It's not a coincidence, by the way. It's not a coincidence that that is 1 business day prior to record. So the X date, that's what that is. That's the X date. And the X date is 1 business day prior to record. It makes sense that it's 1 business day prior to record because regular settlement is T+2. And so it looks like the answer to 71, we said it's the first date on which the stock no longer trades with the dividend attached, is going to be Friday, June 6th. So a couple test questions here. What? Couple test questions here. Let me put it where we can see it. There's the little chart I gave you. I would definitely know when is the X date, 1 business day prior to record. I know what is the X date. It's the first date on which the stock no longer trades with the dividend attached. I believe this was, I believe this was a 45-cent dividend. So let me just go back up. Yeah. And so what we would expect, by the way, ladies and gentlemen, let's just put that in here. We would expect that if this stock, I'll just make up a number. We would expect that the stock closed at 45 on Thursday, and this was going to pay a 45-cent dividend. We would expect it to open up at 44.35. It's going to go down. It should go down by the amount of the dividend. What was it? 45 cents, I think. Was it 45-cent dividend? Let me just check again. If it was 45, that would be 45. Come on, Dean. So it should open up at something less than that. Okay, let me see what it was. Was it 45-cent dividend? Whoop. Yeah. So that's what should happen. That's what should happen. I would definitely know the Security Investor Protection Corporation. You know, the Security Investor Protection Corporation doesn't cover you for commodities. Commodities are not securities. And I would definitely know it covers you for up to $500,000, of which no more than $250,000 can be cash per separate customer. I would definitely, as a SIE test taker, know SIE. So there's certain things we know where they are, like 529s and SIPC and money laundering and, you know, that kind of stuff. So let me clean up my reverse split. How embarrassing is this? General Electric was a blue chip all the way till it wasn't. And General Electric recently did a 10-for-1 reverse. How embarrassing. So the idea here is to get our share price going up. So now you're going to have a lower number of shares at a higher price. So it's the opposite of a forward split. And usually we do this to get the stock up. And that's the whole point of doing this. So GE was, I think, $9. They did a 10-for-1 split. Now it's $90. And so if you had 100 shares of GE, now you have 10 shares of GE. So you have less shares at a higher price. So that's the whole point of doing a reverse split. So just be careful on the test whether you're being asked about a forward split or reverse split. don't be looking for tricks, but they're there, not tricks, but just, it's a giant reading test. So just make sure you're reading carefully. I tell you how important it is to get a good night's of rest the night before. So, your reading skills are on top as good as they possibly can. All right, automatic disqualification for an individual. Remember, we talked about this before, and we said there are yes answers. There are reasons for statutory disqualification. As you recall, in that previous example I gave you, I said conviction of a felony within the last 10 years. And I told you a misdemeanor involving monies or securities. A customer hasn't done any transactions with us in the past 18 months. So the minimum standard to send you a statement is quarterly. Remember, the exception to that would be if it was a penny stocking account, then it would be monthly. Okay, well, I hope you did well. If you were using that as a kind of a practice opportunity for you, this will be Tuesday. I don't know, probably shouldn't tell you Tuesday, because if you're watching this 6 months from now, it'll already be up as a regular video. But we'll premiere it. All new content I premiere on Tuesday, 3 p.m. my time in Las Vegas is when we do uploads. When I do the premieres, I'm there, and there's a chat I run alongside of the premiere. So while we're watching the video, I chat with you about any FINRA or any NASA exam you're taking. So even though this will be, an SIE practice test that we'll be premiering, the chat is for whatever anybody wants to talk about. Okay, so if you found this worthwhile, make sure you smash that like button for me, and you might want to subscribe so you don't miss any Tuesday content, and share the channel. USIEs, I'm so excited that we've seen such a major uptick in the SIE playlist and being able to help people before they're on the second leg of their journey. The channel has been kind of overweighted on Series 7 in terms of viewership and subscribership. And I really am so excited to see that there's been the SIE coming on strong. I always tell people 7 to, tell the SIE people to come to the channel. So I'm pretty excited. I'll try and make sure that I continue to, help the SIEs and put some more stuff up there. So I'll talk to you later, and I'll see you Tuesday. Bye-bye.